This is the human timeline, where history meets finance and the future hides in plain sight. And today, we're going to talk about something that quietly runs your life, your paycheck, your rent, your taxes, your future dreams, and even your past mistakes, the architecture of US money, and why debt. Not gold or productivity or politics is what makes the modern dollar exist at all. If this sounds dramatic, it should. Because the United States did not just build an economy. It built a machine made of promises. And every one of those promises has a price, a timeline, an interest rate, and a signature somewhere deep inside a database at the US Treasury. Before we dive in, subscribe to The Human Timeline, the American channel where economics becomes story, history becomes clarity, and finance becomes the plot twist you didn't see coming. Let's start from the most uncomfortable truth in American economics. The US dollar is not backed by gold, silver, land, or anything physically stored in a vault. It is backed by obligation, the obligation of the US government to pay its bills, the obligation of workers to generate taxable income, and the obligation of the global economy to keep using dollars even when everything feels like it's on fire. Money works because debt works. And if debt stopped working, money would vanish like steam. But this wasn't always obvious. In 1790, when Alexander Hamilton wrote his famous report on public credit, he argued something radical. The young country shouldn't pay off its debts as fast as possible. It should keep them, maintain them, manage them, and turn them into the backbone of national identity. According to Treasury archives, early U.S. public debt was about $77 million. In today's economy, that wouldn't fund a week of federal operations, but in Hamilton's mind it was enough to forge a fiscal nation out of 13 suspicious states that barely trusted each other. So he bundled the states' war debts and transformed them into federal bonds. And in that moment, the United States didn't just become a political union, it became a financial one. Here's the twist. This move didn't make America richer instantly. It made America credible. Investors in London and Amsterdam saw something new, a country that treated its debt like an asset instead of a burden. According to JSTOR's Economic History Studies, U.S. debt became one of the most trusted instruments in global finance within a single generation. Why? Because the U.S. didn't run from its obligations, it engineered them. Fast forward to centuries. According to the Congressional Budget Office, U.S. public debt is now about $35 trillion. That number is so large it's basically abstract art. But what matters more is the interest. The GAO reports that annual interest payments now approach $700 billion, more than the budgets of multiple federal departments combined. And yet the world still lines up to buy Treasury bonds. China, Japan, pension funds, banks, hedge funds, insurance companies, and even the Federal Reserve itself treat U.S. government IOUs as the safest investment ever created. Not because the U.S. never makes mistakes, but because the U.S. never misses a payment. And here's where things get strange. Debt creates money. Literally, when the Treasury issues bonds, banks buy them using reserves. Those reserves then circulate into the financial system, and new dollars appear. According to the Federal Reserve, about 80% of modern U.S. dollars are created through credit expansion, loans, mortgages, corporate bonds, Treasury securities. Money is no longer a thing. It's an agreement with a timestamp. Imagine if your paycheck were printed each week only after someone borrowed money. In a way, it is. The entire system flows like this. Treasury issues debt, financial markets buy it, banks expand, deposits consumers, and companies borrow while Fed taxes collected. Treasury pays, interest cycle repeats. Think of it as a 24-hour heartbeat. As long as it beats, the system lives. But what does backed by debt really mean for you? 30. Mortgage exists only because the Treasury bond market exists. It means your bank account only exists because banks loan out more money than they actually have. It means your credit card is a miniature version of the US government, issuing promises today with the assumption that future income will pay for them. This architecture raises a big, uncomfortable question. If money is created through borrowing, then what is work actually paying for? Your labor isn't generating money, it's servicing the money that borrowing already created. In other words, work doesn't create value, work validates debt. Humor me for a moment. If aliens landed tomorrow and asked, "What do your citizens do all day?" The honest answer might be, "We wake up, drink caffeine, and go out into the world," to justify the trillions of dollars in IOUs our ancestors invented. Now, let's look backward. Throughout history, civilizations based their money on something tangible: grain in Mesopotamia, bronze in China, silver Ganj. But grain spoils, silver fluctuates, and gold is heavy. Debt, on the other hand, debt can expand infinitely as long as people believe the future exists. The US monetized belief so effectively that, according to the bank, for international settlements, US dollars make up about 60% of all global foreign exchange reserves. But here's the genius of the American system. It isn't built on optimism alone. It is built on math. The same mathematics behind interest rates, inflation, and compound growth also governs risk, time, and human behavior. When the Federal Reserve adjusts interest rates, it is literally adjusting the speed at which time passes in the financial world. Lower rates. The future feels close and cheap. Higher rates. The future feels distant and expensive. Your mortgage rate is basically a translation of how costly tomorrow feels to your bank. This is why the 2008 financial crisis was such a turning point. For the first time, Americans saw what happens when belief evaporates. Housing collapsed, credit froze, and the Federal Reserve had to create trillions of dollars through emergency lending facilities. But here's the twist. The crisis didn't kill the architecture, it reinforced it. The Fed learned that the system survives not by avoiding debt, but by carefully managing it. Quantitative easing wasn't a bailout. It was a re-architecting of time itself, stretching obligations into the future and smoothing them over the present. According to Federal Reserve data, QE increased the monetary base by more than $3 trillion. And here's the ironic part. Global demand for dollars actually went up. During the pandemic, in 2020, the US government executed the largest debt expansion in its history, roughly $4 trillion in a single year. Stimulus checks, PPP loans, unemployment support, all made possible because the architecture was already built. Debt didn't just replace work, debt became work. According to the Bureau of Labor Statistics, productivity dropped while incomes were preserved. The system learned something unintentionally. You can freeze an economy and still pay people as long as debt expands. This brings us to another uncomfortable truth. Debt organizes society. Think about it. Your credit score determines where you live. Your student loans determine your career path. Your mortgage determines your city. Corporate debt determines your employer's risk tolerance. Government debt determines your taxes and inflation. Debt isn't a financial tool, it's a social technology. In ancient Mesopotamia, rulers would periodically erase all debts so society didn't collapse. According to Princeton University's historical economics research, these jubilees were essential for preventing inequality from spiraling. But modern economies can't erase debt. They're built on it. Erase the debt, and you erase the money. Imagine waking up tomorrow in a debt-free America. No mortgages, no loans, no Treasury bonds, no corporate debt. It sounds peaceful until you realize there would be no banks, no financial markets, no pensions, no insurance, no government salaries, and no US dollar. Your bank account would be as empty as your student loan balance. Debt keeps everything moving. So why doesn't it collapse? Because the architecture isn't built on stability, it's built on continuity. As long as the US keeps rolling over its debt, and as long as markets keep trusting Treasury bonds, the structure holds. This is why Treasury auctions are more important than most elections. According to Treasury.gov, the US holds auctions multiple times every week. And every time, billions of dollars of new government debt are absorbed into the markets with the enthusiasm of people buying Taylor Swift tickets. But here's the part no documentary ever tells you. You participate in the architecture, whether you like it or not. When you pay taxes, you reinforce it. When you borrow money, you reinforce it. Even when you save money. You're holding dollars whose entire value depends on the Treasury's ability to owe money responsibly. Every dollar is a tiny, folded up Treasury bond. You don't see the signature, but it's there. So where does this lead? According to the CBO, interest payments could become the single largest federal expense within a decade, larger than defense. Social Security or Medicare. When that happens, politics will change, but the architecture will not. Because the architecture isn't political, it's structural. It's mathematical. It's the invisible scaffolding behind your daily life. But here's the trending the slakraki tia design. Let's society borrow innovation, borrow growth, and borrow stability. Without it, human progress would collapse into a cash-only civilization. Debt is how we build things bigger than our lifetimes. So the next time you hear someone say the national debt is out of control, remember, the American economy is not a household. It does not run on cash. It runs on architecture, an architecture of obligations, expectations, and continuous refinancing. Matitia story. And the US dollar is the most successful story ever told. This is the human timeline, where history meets finance and the economy becomes a little less mysterious and a lot more fascinating. Subscribe for more stories like this, based on verified data, official government sources, and the belief that understanding money is the first step toward understanding power.